Welcome. So, in today's explainer, we're diving into a topic that absolutely frustrates so many learners who are just trying to decode those flashing, shifting charts you see literally everywhere in the financial world. Today, we're demystifying financial charts using only the simplest, most fundamental concepts. Seriously, no clutter, no confusion, just you, the chart, and the raw story the market is trying to tell you. You know, trading often seems like the exclusive land of bankers, rows of monitors, and, well, ulcer medication. Does that resonate with you? I think we've all been there. You pull up a stock or forex chart for the very first time, and it genuinely looks like the Matrix. It's stressful, with confusing squiggly lines all over the place, but it really doesn't have to be that way. That overwhelming feeling, it usually comes from looking at charts filled with messy, complicated indicators before you even grasp the absolute basics. To get past that overwhelm, we need to focus on what's called naked price action. By stripping away all the noise, forget the moving averages, the standard deviations, the overlapping bands for a second, we get to focus purely on the visual story. Naked price action is simply the raw, most critical data. It's the continuous, real-time tug of war between the buyers, who we call the bulls, and the sellers, who we call the bears. When you learn to read this raw data, you realize every single mark on the chart is a literal footprint of that exact battle. Here is our roadmap for today. We'll cover 1. Candlestick charts, 2. Anatomy of a candle, 3. The story of the wicks, 4. Basic patterns, and 5. Market psychology. Let's jump right in. Section 1. Candlestick charts. Think of these as market scorecards. Try not to view these charts as a complex math problem. Instead, look at them as a series of scorecards. A single candle represents the entire history of price action for one specific window of time. If you're looking at a 5-minute chart, every single fully formed candle holds all the vital information of what happened during that exact 5-minute window. If it's a daily chart, one candle is the scorecard for that entire day. The time frames can vary, but the way the information is structured, it's always identical. Section 2. Anatomy of a candle. These are our basic building blocks. Notice the direct contrast here. You're generally going to see two types of candles. A bullish candle, which is often green or blue, and a bearish candle, usually red or black. Bullish simply means the buyers won the period. The price went up. Bearish means the sellers won. The price went down. Now, that fat rectangular part in the middle, that's called the real body. It shows you exactly where the price opened and where it closed. For a green bullish candle, it opens at the bottom of the body and closes higher at the top. For a red bearish candle, it's just flipped. It opens at the top of the body and closes lower at the bottom. I really want you to mentally map these 4 crucial data points, often called OHLC: open, high, low, and close. The open and close make up that fat body we just talked about. The high and the low are simply the absolute highest and lowest prices reached during that specific time, and they extend out beyond that fat rectangular body. Let's look a little closer at those extensions. Section 3. The story of the wicks. This is where the real market drama is revealed. You see those thin vertical lines extending out from the bodies? Those are the wicks, sometimes called shadows or tails. They represent the absolute highest and lowest prices touched before the time ran out on that candle. But here's why this is absolutely crucial. They visually reveal the failure of one camp. If you see a really long wick at the top of a candle, it means the bulls pushed the price way up there, hitting an extreme high, but they ultimately failed to hold that ground. The bears actually fought back and pushed the price down before the candle closed. It's literally visual evidence of a failed offensive. Section 4. Basic patterns. Let's build up your market vocabulary. The very first word in our vocabulary is the doji. A doji is a candlestick with little to no real body. This brilliantly illustrates a perfect tie in our tug of war. The price opened, went up, went down, but when the clock finally ran out, it closed at the exact same level it started. Neither the bulls nor the bears could claim victory. When you spot one of these, it signals intense market indecision. Let's walk through 3 specific patterns, showing how just 1 or 2 candles can act as a super reliable clue. First up, the Marubozu. It has a solid body with 0 wicks. That means pure, uninterrupted directional conviction from the open all the way to the close. Expect the trend to continue. Next is the shooting star, a small lower body with a massive upper wick. Remembering what we just learned about wicks, this shows a massive rejection of high prices, hinting at a downward reversal. Finally, the bullish engulfing. This is a 2-candle pattern, where a massive green body completely swallows the prior red body. It tells you buyers are entirely overwhelming sellers, signaling an upward reversal. Section 5. Reading Market Psychology. Tracking the smart money. The market isn't just a bunch of random shapes. Massive institutions like big banks trade in such huge volumes that they actually need to find a lot of regular traders to buy from or sell to. And because regular retail traders are kind of predictable, they place their stop loss or safety nets at very obvious levels. Institutions will actually push the price to these obvious levels to purposely trigger those safety nets. This event is called a liquidity grab. They do this so they can absorb enough shares to fill their own massive orders. As our source material notes, a long wick indicates a lot of sellers stepped into the market. A massive wick on your chart is very often the visual footprint of that liquidity trap snapping shut. A long lower wick that dips below an obvious support level means the institution swept the retail stops, grabbed the liquidity, and immediately reversed the price back up. That thin little line on your screen, it's literally the footprint of smart money at work. Which leaves us with this final provocative thought. The next time you look at a chart, don't just see green and red boxes. Ask yourself, is this next candle trying to trick me? Is it sweeping my stops, or is it telling the truth about the trend? Candlesticks are human psychological scorecards. Armed with this knowledge, you really don't need 100 messy indicators on your screen. You have the vocabulary to read the naked truth of the market. Thanks for joining me for this explainer, and happy chart reading.